Hi, good morning everybody. This is week 2 and this is lecture 2 for this week. And then this lecture is supposed to be for Wednesday 27th of October. Topic 2. The title of this topic is Introduction to Accounting. Okay, in this topic, you will learn about accounting rules. Actually, it is about accountant rules. Accountant rules, profession, and ethics. And then you will learn a bit about accounting standards and principle. And then you will also learn about accounting assumptions and conventions. Okay, first thing first, remember what is accounting? Very important. You have to know what is accounting before you can understand things about or things related to accounting. Okay, remember this. Accounting, the simple definition of accounting is a process to analyze and record financial transaction and to report financial information. For financial accounting, you analyze business transaction and then you record business transaction, and then at the end of the year or at the end of the accounting period, you report whether the business is making profit or loss, and you also report the asset, liabilities, and equity of the business. Okay, now we look at the person who do accounting works. If you have a big business and then you are the owner of the business, maybe you most of the time you will hire somebody to do the accounting work, to do the accounting record. So the person who do accounting work and record is called accountant. So see the first point in this slide. What does an accountant do? Okay, see the first point there. Accountants preparing accounts, budget, and managing financial information. That is the main responsibility of an accountant. He or she will have to prepare accounts or to record business transaction in the accounts, and then he or she will prepare budget, and then also he or she will have to manage financial information related to the business, to the organization where he or she works. Okay, the next thing is advising employer or client with financial matter. Now many accounting works such as record keeping and maybe prepare budget can be done using computer software. It can be done very quickly and easily using computer software. So this software have made accountant works easier. And so now most of the time this record keeping can be done using software. So accountant now become the advisor to the employer or client for financial matters. So many years ago, the thing that accountant will do is record everything manually, do accounting work manually. Now we have software, we have apps. The recording process can be done using computer. So the function of an accountant now mostly to advise employer or client about financial matter. Number 3, prepare and examine financial records, assuring information is up to date and accurate. Okay. So Now, the second thing about the profession of accountant. There are many accountants out there, but the accountant that will enjoy, respect, and good salary, and many more benefit is chartered accountant. Chartered accountant is like registered accountant. Accountant registered or recognized by the government. In Malaysia, a chartered accountant is an accountant that is registered with Malaysian Institute of Accountant. Malaysian Institute of Accountant is a government body. If a person wants to be a chartered accountant, a registered accountant, an accountant that is recognized by Malaysian government, he or she has to register with MIA, Malaysian Institute of Accountant. If you are in China, I think you will have something like that. There is a government body where an accountant has to register and got recognition from that government body. If you are in Indonesia, also the same thing will happen. If a person works as an accountant, but he or she has not registered or got recognition from government, then he or she cannot function fully as an accountant. He or she cannot sign document, cannot give assurance service, etc. So a person has to be a chartered accountant to got recognition, to get recognition, to get good salary, to get respect from the to get respect in the workplace. Okay, so in Malaysia, to get the title of chartered accountant from Malaysian Institute of Accountant, you have to do this. First, a person has to pass Bachelor of Accounting degree in recognized Malaysian universities, plus he or she has to have 3 years working experience. If the person has these two things, he or she can apply for a chartered accountant title from Malaysian Institute of Accountant. Or a person is a member of a recognized professional accounting body, like ACCA, CIMA, or in Malaysia we have MICPA, stands for Malaysian Institute of Certified Practice Accountant. So if a person has this professional accounting body membership, he or she can apply for MIA chartered accountant title. The third way to get the chartered accountant title in Malaysia is to pass the Malaysian Institute of Accountant qualifying exam, plus 3 years working experience. MIA also has their own examination. If you want to become a member of MIA, you can sit for the examination conducted by MIA, and then you have to have 3 years working experience. You have to have 3 years experience working under an accountant in the private sector or in the public sector. So if somebody asks you how to become a chartered accountant in Malaysia, then the answer is one of these 3 ways. Okay, so accountant is responsible to prepare to do accounting record, to prepare income statement, to prepare financial statement, to prepare budget, etc. So accountant has to be a trusted person. If the accountant is not a trusted person, if the accountant do something that is not honest, then people cannot will not believe the thing that the accountant produce. If the accountant is not honest, then let's say the accountant like to how to say that? Okay, the thing that I want to say is a chartered accountant and also an accountant has to maintain ethics. He has to be an ethical person. Ethical means ethics means acceptable standards of good and bad behavior. If a person is an honest person, do the correct things, then we say that the person maintain good ethics. But if a person always lie to the customer, lie to the employer, willing to lie to the public, then that person is not maintaining ethic. So it is very important for an accountant to be a person that maintain good ethics. And also, when an accountant is working in an organization, when he or she prepare account or do accounting works, prepare budgets or report financial information, etc., sometimes the accountant will find wrongdoings done by employees in an organization. Maybe the accountant found that one employer stealing from the organization, another employer hide bad information about an organization, etc. So when an accountant sees something like that, the accountant has to do these 3 steps. First, the accountant has to identify ethical concerns. The accountant has to use ethics to recognize an ethical concerns. Ethical concerns means wrongdoing. When an accountant knows something bad happen, something not good happen, or wrongdoing happen in an organization, then the accountant firstly has to identify the ethical concern or the problem, and then the accountant has to analyze options or to consider all consequences. When auditor know the type of the wrongdoing, when the accountant know what is the type of the wrongdoings or wrong things happen, the accountant has to consider what will be the consequences of these wrongdoings or bad things that happen in an organization. After that, the step 3 that the accountant has to do is to make ethical decision. The accountant has to take action to report the matters to the higher level or higher level people like directors or CEO or what else, financial controller or etc. And then, or the accountant, maybe the accountant, the problem is very serious, the accountant has to report to the uh, to the police or other government bodies that can take action, like bribery or something, or corporate crimes division or something. So the accountant has to make the best decision, whether to report to the higher level people like director, CEO, etc., or to report to the police or corporate crime division or bribe corruption agency or something. Or the problem is very small, so the accountant has to warn the workers only, things like that. The accountant has to make the best decision for the situation, for the ethical concerns that he or she sees. Okay, most of the time, the wrongdoings that happen in an organization is called fraud. Fraud is like cheating. A worker steal from the business or organization, misuse of the organization's asset or something like that. So we, in general, we call it fraud. There are three factors that must exist for a person to commit fraud. These three factors encourage a person to commit fraud. The first factor is opportunity. A person will do fraud if he or she envision a way to commit fraud with low risk of getting caught. Most of the time, a person will do fraud when he or she thinks that the fraud can be done, and also he or she cannot be caught, will not be caught by anybody. So that is one factor. The second factor is rationalization. Rationalization is something like this: a person will do fraud if he or she thinks that the wrongdoing is not bad. He or she maybe think that, oh, this is a very small thing, it's not very serious, so he or she will do it. If he or she thinks that the thing that is to be done is bad, is seriously bad, then he or she will not do it. The third factor is pressure. A person will do fraud, will steal from the organization or business, will hide information, or will use business asset for personal purpose. If there is a pressure, pressure means maybe he or she has to pay a very he or she has personal bank loan that has to be settled. So there is a pressure, he or she has to get cash quickly. So this thing will make a person will cause a person to do fraud. So if to avoid fraud from happen, a business or an organization has to eliminate this kind of these three factors, or minimize these three factors, so the possibility of fraud to happen will become low. Okay, the next thing about this topic 2 is you have to know about accounting standard. Okay, remember, the focus now is on financial accounting. The financial accounting is the type of accounting that you can use to record business transaction, and then to prepare financial statement, so that you will see whether the business is making profit or loss, and also you can see the assets, liabilities, and equity of the business. So financial accounting, to do financial accounting, everybody has to follow accounting standard. Accounting standard is like a book. This book explains about how to do the accounting record, and also how to report the asset, the liability, the revenue, and also how to show the income statement, the format of the income statement, balance sheet, statement of equity, statement of cash flow, etc. in the financial statement. This book explains in detail about the way to do accounting record, and also the way to prepare the financial statement, to prepare the income statement, balance sheet, etc. So every company, every business has to follow this accounting standard or accounting book, accounting standard, so that every business will produce consistent financial statement and using consistent way of keeping accounting report. So accounting standard in Malaysia, the organization that is responsible to release financial accounting standard is called MASB. MASB, Malaysian Accounting Standard Board. Okay, remember that. Public companies in Malaysia have to use Malaysian Financial Reporting Standard, or the short form is MFRS. So remember this, every public companies in Malaysia, public companies are big companies listed in Bursa Malaysia. Okay, so it is compulsory for them to use MFRS, Malaysian Financial Reporting Standard. That is the standard. But for private companies like sole proprietorship, including the sole proprietorship, private limited companies, partnership, etc., they may choose to apply MFRS or MPERS. MPERS stands for Malaysian Private Entities Reporting Standard. MPERS is a simpler accounting standard compared to MFRS. MFRS, the standards is ask the user to disclose very detailed information. MPERS is simpler, easier to use. So that's why private companies or smaller companies, they can use MPERS. It is easier to prepare accounting according to MPERS, and also it is cheaper. It is cheaper to follow. When you prepare accounting record and you prepare financial statement, there are costs related to that work. You have to hire accountants. If for MFRS, the standard asks for detailed information, so more accountant works, so more expensive. MPERS is simpler, so easy to prepare, and it is cheaper to prepare. So you hire accountant, not many hours of work is needed, so cheaper. So you have to remember this. Public companies in Malaysia have to follow or use MFRS, but private companies, including small businesses, they have choices. They can apply MFRS or NPERS. Okay, now in accounting, we have principles, assumptions, and constraints. These are the things that an accountant or a person has to follow when he or she wants to do accounting works, to do accounting record, and also to prepare financial statement. It is like rules that we use in accounting. The thing is like this. The example is like this, the logic. If you want to use the road, you have to follow certain rules. For example, you have to drive in the left side of the road. When you see a traffic light, if the light is red, you have to stop. If the light is green, you can go through. Sometimes there is no logic for that. For example, why you have to drive in the left? Why not in the right? Or why the light is red? You have to stop. Not use other color. For example, purple or other colors. So there is no logic sometimes. Sometimes there is no logic. But the thing that you have to know is, if you do not follow the rules, problem will happen. If you drive in the right side of the road, somebody will hit you. If you see a traffic light, the light is red, but you still go through, there will be a problem. Same goes to accounting. Accounting, we have principles, assumption, and constraint. Sometimes we cannot see the logic, but we have to follow the rules, the principles, assumption, and constraint. Otherwise, we will have problems when we do accounting record and when we prepare the financial statement. Okay, let's see these principles, assumptions, and constraint. Okay, see here, general principles are the assumptions, concepts, and guidelines for preparing financial statement. So, see, like I said earlier, these are the rules that you have to follow when you want to do accounting record and when you want to prepare financial statement. Specific principles are detailed rules used in reporting business transactions and events. So the focus here is to look at the general principle. Okay, these are the principles that you have to know. The first one is called measurement principle or cost principle, or sometimes we call it historical cost principle. So when you want to do accounting work and when you want to prepare financial statement, you have to follow this. What is the cost principle or historical cost principle? So see there in the red box, accounting information is based on actual cost. Actual cost is considered objective. Okay, so actually it is something like this. The cost principle says, when you want to record the value of an asset, you have to record it at the purchase price, not at the current market value or replacement value or other price or other value. Okay, remember that. Let's say you have a business. 3 years ago, you have purchased a building. The price of the building is $260,000. 3 years ago. Today, the value of the value of the building or the price of the building today is $350,000. But when you record the value of the building in your account, you have to record it at $260,000, not $350,000. This today value, because in accounting you follow the historical cost principle or cost principle, which says that when you have an asset in accounting, you have to record it at the purchase price. Okay. Okay, the second principle is revenue recognition principle. So in short, revenue recognition principle says you have to record revenue for a business when the transaction happen, not when the business receive cash from customer. So let's say you have a business. Today a customer come. He takes 5 items and the value of the item is $100. He takes 5 items. He said he will pay at the end of this month. So when is the time to record the revenue? When a customer buy something from your shop, you have to record it as a revenue. So when is the time to record the revenue? Today or at the end of the month when the customer pay the $100? The answer is today, because in accounting we follow this principle. Revenue recognition principle says you record the revenue when the transaction happen. The transaction happen today. The customer takes the items today, so you record the revenue today, $100. Not when you receive cash at the end of the month. Okay, so remember that. We will use this principle when you learn about how to do accounting record in the later chapter. Expense recognition principle, same goes to expenses. You record expenses when the transaction happen, not when you pay cash. Let's say you have a business and then you have one worker. Every month you pay the worker $1,200. So this month is October. So even though the practice of your business is like this, the salary for this month will be paid at on the 5th day of the next month. So the salary for the month of October, this month, will be paid on 5th of November. Now, a question arises. For this salary is an expense. So when is the time to record the salary expense? On the 31st of October or 5th of November? Okay, the answer is 31st of October. Why? Because in accounting, we record the expenses when it happened, not when you pay the cash. The salary of this worker has worked in the month of October. So the salary has to be recorded in the month of October. Even though you pay the worker at 5th of November, but the salary expense has to be recorded at 31st of October because the worker has worked in the month of October. Okay, just remember that in accounting, you record expenses when it happened, not when you pay cash. Later, in a later chapter, I will show you again how to do the record. At this point, you just have to know the principle only. Okay, the next principle is full disclosure principle. So full disclosure principle says when you prepare financial statement, when you prepare the balance sheet, income statement, statement of equity, statement of cash flow, and notes to the account, you have to disclose all relevant information. You cannot hide information. And then we have accounting assumptions. Okay, the first assumption that we have is going concern assumption. Going concern assumption says When you prepare accounting record for a business, you have to assume that the business will continue to exist in the future. When you can assume that the business will continue to exist in the future, then you can categorize assets into current assets and long-term, current asset and non-current assets. Liabilities can be categorized into current liabilities and long-term liabilities. That is the reason. Otherwise, that's the reason. You have to assume that a business will continue to exist in the future. And then monetary assumption. See the green box there? Light green box. Monetary unit assumptions. When you do accounting record, you can record only items that can be expressed in terms of dollar and cents only. Items that cannot be expressed in terms of dollar and cents cannot be recorded in the account. For example, there is a business. And then the business has a building. Can you record the building as an asset? Yes, because you can express the value of the building in terms of dollar and cents. Maybe the building value is $260,000, maybe. So you can record it. But let's say there is a business, and then the business is located in a very good location. Many customers there. The business has access to many customers, to good location. Do you think location is an asset? Yes, it is an asset because it benefits the business in terms of giving access to many customers. But can you record location in the business account? No, because location is one thing that cannot be expressed in terms of dollar and cents. So in accounting, we only can record items that can be expressed in terms of dollar and cents. Time period assumption. Time period assumption says the life of a business can be divided into specific periods, for such as months and years. Remember, when you apply going concern assumption, you have to assume that the business will continue to exist in the future. But when you apply the time period assumption, you have to assume that the life of this business can be divided into periods, let's say months or year. When you assume that the life of the business can be divided into periods, then you can calculate profit. Profit for 1 month, or profit for 1 year, or profit for 6 months. That is possible because you assume that the life of the business can be divided into periods. And number 4, accounting assumptions number 4 is in the dark green box there. Business entity assumption. So business entity assumption, sometimes we call it a separate business entity assumption. In accounting, so this assumption says in accounting, the owner of the business and the business are separate entity. If in the future you start a business, in accounting we see you, the owner of the business, and your business as different entities. The effect of this assumption is when you do accounting record, you record things related to your business only, not things related to you, the owner of the business. The example is like this. Let's say one day you have started a business, and then one day you pay electricity for your business, $150, and then that $150 has to be recorded in the business account. You have to record electricity expense or utility expense $150. But let's say in the next day you pay your house electricity bill. Your house electricity bill is $100. Can you record that $100 in the business accounting record? You cannot, because you, the owner, and the business are different entity. The accounting record for the business is for the business transaction, not your personal expenses or personal transaction. Okay, remember that. And then there are three, see here, 3 or 4 accounting constraints. Constraints are limitations. Okay, first one, see here, cost benefit constraint. It means that only information with benefits of disclosure greater than the cost need to be disclosed. So when you do accounting works, always remember, let's say in the future you have a business, you have to do accounting record. Always remember, you do the record as long as the benefit of doing so is greater than cost of doing so. If you have a small business, you spend small amount of money for the accounting record. So because you have to make sure that the benefit of doing accounting record and report should be greater than the cost. If the cost is too high, then you have to find ways to reduce the cost so that the benefit of doing accounting is greater than the cost. Materiality constraint. The thing is like this. When you have a business in the future, let's say, if you have a business in the future, you will see that even a small business, you will have many data, many transactions. So very difficult actually to handle the accounting works. But you have to use this to aware about this constraint. In accounting, we have materiality constraint. It says that in short, or in a simple way, you have to show or to record important things in detail, but less important items or things you can group them together and create an account for them. The simple example is like this. If you have a business, there are many small expenses. Very difficult for you to record them separately. For example, one day you purchase stamps because you want to post something. Another day you purchase several cups of drinks for your workers just to entertain them. So this kind of expenses very difficult for you if you want to record separately. So you can use an account called miscellaneous expense. Okay, so that is one way to understand materiality constraint. So you focus on big and important items, but for small items and less important items, you can group to get them together and create an account for them. And then we have the final box there, the last box, the bottom box, conservatism. Conservatism means says something like this. When you prepare financial statement, you cannot overstate revenue and profit, and also you cannot overstate asset. Okay, always conservative. You cannot overstate profit and asset. And also you should not understate liabilities. We'll explain more about this when we see the situation in later chapters. When you learn about how to do the accounting record, I will explain, for this situation you have to apply this assumption or this constraint or these principles. Then you will see the logic. Industry practice. Sometimes the way to do the accounting record is influenced by the industry practice. Every businesses in that industry use the same way, so maybe you have to follow the way that is acceptable in the industry to do the accounting record. This one also, if we see this in the later chapters, I will explain about it. So that is the end of topic 2. Do not forget to write your name and matric number in the comment section. I will take that as the lecture attendance.